Hi, this is Randy Finney with the right side of the chart, and this is a mid-session update for Wednesday, April 2nd, 2025. It's 1:13 p.m. Eastern Time as I'm starting the video. I'm going to keep this one relatively brief. We're just going to do a that was then, this is now with the how some of the charts looked back in 2022, right at the end of the first leg down in the bear market. So I'm going to share my thoughts, keep it mainly focused on equity markets. I'm not doing a lot elsewhere today. My plan, I was just doing other things today. I'm going to keep things light. I'm watching the markets. And as I'm still looking and adding on objective, still looking at this as a bounce that offers an objective add-on or re-entry, re-scale back in. I mentioned recently it's not an aggressively all-in short moment at all by any means because of the divergences. I'm going to speak a little on those real quick. Before I do that, I don't want to forget, there's a question put to me. I was going to answer it. I've caught up on all the recent questions going back here. If you put one back here and I missed it on these older posts, let me know. Question that I saw this morning, and I'll just look at those charts and might benefit someone else because these were actually active trade ideas. Randy, what's your thoughts on Mr. Cooper and Rocket Mortgage, COOP and RKT, the rest? And I appreciate this, TGS. I like that summary you give folks what I cover, and people can then jump forward to part of a video that they might have questions on or interest in. Yeah, Stock Ninja, some good comments there. I read that. Kind of agree with you there. That makes sense. Okay, let's talk about the specialty finance companies. I don't know if you who posted that question were a subscriber back then, but I gave short trade ideas on three of the lenders. RKT, UWMC, mortgage related company. I'm sorry. Some of these manage just do the servicing of loans and all that, but they're all in the same subsector, which is specialty finance. Where did I do that? Okay, it would have been back here, Rocket, and on this day, all three, I gave those charts. I'll cue the post. You know what? I have it. Here it is. That was on the 19th. So we shorted all three, Rocket, COOP, and UWMC collectively. Like to take shotgun approach, and sometimes on a sector or several stocks that kind of do a similar thing, going to move together. And this is the group right there, specialty finance. So back to the charts. That was the 19th. So we nailed the high, and the reason for that, I spotted that bearish engulfing candle, just like I did in the markets a few weeks ago. Told you that's a swing trend short entry to pick the top with minimal downside, and that was certainly the top there. You can call it what you want, but I think a 52% drop, I think that's safe to say that qualifies as a bear market by most people's metric. We hit my fifth and final target, reversed. So where do we go from now? I don't have much of an opinion. We did recently put in a divergent high. I do still believe that we are in the early stages of a much longer term bear market in the stock market, which would imply deeper downside targets. This is just, I just wanted to milk the initial leg down, which I think we did pretty well there. Went slightly past the fifth and final target, but that trade was good for about a 43% profit. And like everything, it got very oversold. You can see buried. And there's a good example what I talk about on the stock market and other things. We started getting oversold when my fourth target zone was hit right there. We went to the bottom of T4 zone, and we had a little relief rally, which you're going to get just like we just had in the stock market. And then we became more oversold. That's a signature of a bear market. Oversold, I always say, tends to become more oversold or stay oversold for an extended period of time. Where do we go now? I have no opinion on this chart. We're not oversold. We're not overbought. PPO is back above the zero line, curling back up. Been a nice, probably big short covering rally recently. Okay, I'm going to stop there because I don't have much of an opinion. I wouldn't go long. I wouldn't go short. The other two were UWMC. Again, we shorted the same day, right after the bearish engulfing candles. Let me make sure. What did I say? Let me go back to that post. I'm sorry. 19th. Okay, 19th. This one, I just want to make sure of September. So that one had already broken down. Yep, that's right. So we got it right on that kickback rally following the divergent high and bearish engulfing candle, then the breakdown. And so we shorted there, went down. Split the crosshairs between my third and fourth target right there, and we just hit that where the crosshairs are. So we're good for a 41% drop on that. Had a positive divergence. I believe I did update it at the time. Yes, I did. Go back in there somewhere around that time. I expected a bounce in this one because we had a nice bullish falling wedge with clean positive divergence. You can see clean separation on the PPO, the type that I like to see, and then the breakout of the bullish falling wedge of the downtrend line, and that was good for. I even mentioned gaming it back to T2. That was good for about a 15-16% rally. Got rejected there. Tested that recent low, but made an even bigger divergent low. So this one, I'll say this directly. If the market does happen to go back, takes out the 200-day moving averages, stock market goes anywhere near the highs or above, this is a great looking chart. You have another downtrend line right there, and an even bigger, the same divergence, it's only grown larger. So the potential, if something happens where we see a big pickup in mortgage refinancing or new mortgages or whatever. Now, with that being said, this is, typical kind of bear market setup. It's what we call a bull trap. It's a beautiful looking chart. However, we are below the 200-day moving averages. So sometimes you just have to look at the bigger picture and say, this stock right now is in a bear market and it's below its 200-day moving averages. There's the 200 days right there. And once you start taking back the 200s, you're in a bull trend. If that plays out, yeah, there's certainly more upside. But right now, recognize it for what it is. Like, for example, right here, you had nice big positive divergence, aka bullish divergence, but it only played out for a brief 1-day short or 2-day short covering rally with another big leg down. So you got to be a little skeptical, if you will. Now, again, take them if you want to take them. My job is to point out the levels. So you could take it with a stop somewhat below the recent lows. And that's the thing, guys. If you want to take shots, whether you're long-term bullish or you're just agnostic trader, you just looking at the charts, and you don't care if you're long or short. Just don't fall in love with any stock. That holds true really at any point in time, but especially in bear markets. So you take a shot there, you take a breakout on the trend line and then this 587 resistance level. These would be your targets in reverse. They were my targets on the way down. If I listed T2, which it was at 662 back on, you can see I created that on September 19th. If back then, when we were way up here, I thought this was a support level which you'd get a reaction, and you did. I always say a reaction comes in two ways, time or price. That was what I call my hacky sack reaction. When you drop a tennis ball or golf ball to a concrete floor, it's going to bounce, and that's a reaction in price. And when you drop a hacky sack onto a concrete floor, it's going to go thud, hit the floor, and stay there. And that's what this stock did for about a week or two. Then down to my next target. Then we had a bounce. And then, again, that got truncated there, probably with the market and some other things bouncing right there. Now, where I'm going with that is, so reaction, since that line was created, additional reactions, that's about a week there. 1, 2, 3, 4, 5 candles trading, another week plus trading there, also the 200 days. So if back here, right here, when we shorted, I thought this was a key level, and then we had all these additional reactions. It's now much stronger resistance. Remember, before it was support, now it's resistance. Once it was taken out, and that's TA 101, guys. Once support is taken out, it then becomes resistance. And so it was. And so that would be a logical price target. So if you are interested in going long here, or shorting this stock for the next leg down, either or, you'd want to see it go up to about 1690. That's where you'd most likely get a reaction if the stock can rally up to that level, especially without any corrections right before it, get a turnaround reverse, or if you're looking for a longer term trade. And you're also going to look at that. You also have an additional gift, aka the 200-day moving averages just above to act as resistance. So there's your update on UWMC. And COOP, that one only hit my first target. That was right there. So we hit T1. And something else is happening with this one. Again, they all have, I believe, a little bit slightly different, maybe completely different business models. They're in that sphere of, or the subsector specialty lending. But Mr. Cooper, together with its subsidiaries, operates a non-bank servicer of residential mortgage loans in the United States. So see, the servicer isn't going to get hit as bad. They still have to service the existing mortgages. Either way, something's there. I don't know this one. It's the only one of two. I believe I told you at the time. Rocket and UWMC were the only two I took. Those were my two favorites, but I threw this one out. That one hit that. Comment on it or thoughts on it? I don't know. It's still, in fact. This one, if the market takes another leg down, which I still favor, this one's probably going to take it on the chin. In fact, what I would look for right now in this one, I wouldn't buy it with your money here. I don't care that it's at all-time high right now, which is rare with a lot of stocks trading well under their 50 and 200-day moving averages, 52-week lows across the board recently, and this thing's bucking the trend. To me, whatever's going on, I don't know fundamentally. I don't really care. I don't have the time to look into it. But what I would look for is see this big gap up recently. That's an earnings-induced gap. No, it's going to report here. There was some news that made that thing gap up. Look for a gap down. It may not happen, but if it does, you'd have a beautiful island cluster top pattern. That's a great reversal pattern. What that is when you have a big gap up at all-time highs. Look for it after an extended uptrend, just like the bearish engulfing candles we shorted a few weeks back. And what you want to see is gaps on both sides. It leaves an island of candles sitting all up there by themselves. And then it's simple. Instead of the bearish engulfings where you put your stop over the recent highs, on that one, you don't want to see prices move back above the island, or then it's no longer separated by gaps on both sides. So put your stop. I like to give my stop a little bit of room because, the humans and computers and nefarious forces, they know what those patterns are. So if they can, especially on lower volume stocks, Goldman Sachs or whatever, trading desk or big hedge fund with a lot of money, they can't move Apple. They can't move the S&P 500. It's very hard. It's just too big. They can move little companies like this. So what I mean by that, they can run up. If they see where all the stops are clustered at, take your stop. So put it a little bit out of range. In other words, if, and not right at the bottom there. Again, we don't have the sell signal now. So like any trade, if you're new to the site, hear what I'm saying. The most important thing I can say, one of them, is that I give you trade setups and I give you trade ideas, actionable trade ideas. In other words, if I see something break out today and it's a buy signal, I'm going to throw it out to you quick. Say, I like this. It just broke out. It's a long, active, objective long entry. Likewise, on this is what I call a short trade setup. And if the difference, they're on the site. If you go to the trade categories at the top, I define that. A setup is just that, a potential short trade waiting for a catalyst, that specific catalyst in this case. And you could see any other type of reversal pattern, but it's kind of semi-rare to call for an island cluster top before it even happens, but I see it there, and that's just something's going on that spiked this up. Big volume there too. So read there's some news on it. I can guarantee you when I see that kind of volume, and maybe if it's super bullish, I wouldn't touch it. So I would probably recommend, if you're going to short this one individually, read up, see what happened, what caused that big gap, and it looks like they have earnings coming up soon. We're right between earnings. All right, let's go to the markets now. Let's talk markets. We're rallying today. Yesterday, if it was an April Fool's rally, today's a continuation of that. I'm going to get to this daily chart again. We have those positive divergences I told you about, which very well could be the catalyst for a double-digit rally. At this point, I'm still not leaning that way. That's not my preferred scenario. I'm very open to it. That's why I told you before, I highly respect divergences, be they bullish or bearish, especially in a bear market. Again, I'm going to get to that one second. Let's just start out with the 60-minute charts, cover those levels again, kind of recap what's gone on. So, this was what I'd still consider leg one down. We started covering shorts there to game a bounce, hit my preferred target zone right to the button, reverse down, put in a divergent low on the 60-minute chart of QQQ. So this I very much respect. By the skin of its teeth, by that I mean we have lower lows in price, which you need to for positive divergence, and higher lows there ever so slightly, but it's a little bit higher low on the PPO and about an equal low, and that's also divergence. If you have equal lows on the indicators and lower lows on price, that's still positive divergence. Obviously, if you get stronger divergence, that typically is a little more bullish, but not always. But again, let me get to the futures here. We don't have it on the futures, not on both indicators. What I can tell you at this very moment, as I speak, it is 1:27 p.m. I expect a pullback. We just hit a nice resistance level, 480. I've been talking about 480 for a while. That's a nice resistance. We have a gap right here. We tested that gap, then we broke down. It was very impulsive when we did. I would put good odds right now on a reversal off this level. At minimum, a quick pullback trade. At maximum, the start of the next leg down. If we pop through there, you can see the levels. They've been given to you before. As I said, it wouldn't surprise me to see another test of the 200s, maybe even a slight punch through. So my max bounce target zone could still very well be into play just because we reversed so far at my preferred target zone. I haven't erased this yet. That's still a potential right now. And it's just kind of a little mucky right now with everything going on with the the news headlines changing daily and Trump's tariffs and all this and that and the other. All I can tell you is I'll get to in a second the daily charts and kind of reiterate the big picture. So there it is, positive divergence on QQQ 60-minute chart. When I go to SPY, we also have it. You can see here. Let me just, since I have kind of what I call a busy board, a lot of levels. We've been diverging since right here. We had a divergent low. We were long off that divergent low. We hit the preferred bounce target, which was on QQQ right there. And I think on ES, I even gave it to you. Positive divergence. The same divergence that was in place there has been extended because we made a slightly new low. We undercut, which I said was near-term bullish because both QQQ and SPY undercut. So that's one of the most bullish things to me in trading is when you break a support level, especially previous well-watched lows, and then reverse back above because it sucks in some extra short sellers there, blows out weak-handed longs, and then gives you a little more stable holding power for the existing longs, plus the shorts that jumped in get squeezed out. I believe it's a temporary phenomenon. I think we're still squeezing out those shorts that probably bought SQQQ there. But we are at resistance just like SPY. Just like QQQ. There's that gap right there, bottom of the gap. They danced on the gap for a while and then gave it up. And so now we are back to the top of the gap right there. All right. Double resistance. In fact, I'm going to pause this. I'm going to add some shorts as I do this right now. Okay. Let's go to here. Back to, I fired off an order. It popped up another screen. Where was I? I was on this one. Okay. Resistance. Let's go to the futures now. Let's do that. NQ, NASDAQ 100 futures, hourly chart. Nice resistance right here, 19,926. There's that same old gap right there in the futures talked about. We danced on it for a while, broke it there, and it just wasn't what happened? Was that breakdown impulsive? Yeah, that's what you call an impulsive breakdown. We're right back to that point. I would put the odds of close to as high as I can put odds. We're going to have at least a tradable pullback. And then to add to it, see this uptrend line I had right here, which was also taken out? It's a back test of that trend line. So there it is, guys. I'll try to wrap the video up so I can get that out to you. Again, these levels all given in advance. You have to have a trading plan. You have to react. If you are, bearish and trying to, recycle back in, add to short position, if that's part of your trading plan, you have to put yourself in the mindset you want big up days in a bear market. That gives you a better price. It's exactly like being very bullish on something, getting a nice pullback that you're happy to buy on the dip, pullbacks to support. This is just that in reverse. So there it is. Now, if we pop that level, whether we pop it after pullback or not, the next resistance, and just as good, very good resistance, is about 20,094. So we'll call that 20,100, I'm sorry. And then, of course, the other levels. Remember, we already hit my preferred bounce target. My preferred scenario still says that was it, and that was most likely the best, reshorting op, re-entry op before the next leg down runs its course. But anything's possible. There's the bottom of the trading range. We could go up higher. I'm kind of, still not an all-in super aggressive moment right now to me. But once we start reversing it, and if we take out the lows, here's what I want to see. Because remember, I'm talking about the divergence a minute ago on SPY and QQQ. We did have it on both indicators. NQ, the NASDAQ 100 futures, we do have the positive divergence. Remember, that was our first divergent low. It was just a nice setup. We, bounce, leg down, extended the divergence only on the PPO. Right here, there's the previous low on the RSI that was taken out. So you don't have the divergence there. It's not the be all end all, guys, but I do much prefer to see it on all, both NQ, QQQ, SPY, and ES. That's what I like to see. The big caps, futures, and ETFs, 60-minute divergences is what I like to see in bear markets or bull markets to go long for the next, big double-digit bounce up. All right, so that was NQ. We go to ES. ES did have the divergent low right here, right? Bounced up right up to that level, put in a divergent high, sent us down. We had that unbroken bullish falling wedge there, but it never triggered a buy signal. And then we had the downtrend line. We danced on it, but we did break that up recently. That's the catalyst for this next leg up. Those downtrend lines I highlighted, as well as on SPY, just got taken out. But you can see here we had the equal lows at that point. We slightly dipped below it, but no divergence. The previous low from there, the divergence was taken out at that point, and it was also taken out. It was close. Now, if you want to nitpick, yeah, you say it was taken out. You can say those are equal lows, so they're almost equal lows. Sometimes I do see that. And again, so I am open to the potential we could see a double-digit rally. Now, let's talk about that. Let's talk about the charts. Let's go back to the daily charts. Let's look at QQQ, my preferred trading proxy. What I'm going to do right now, see this, remember I talked about the potential bear flags, said I was a little bit longish on SPY, in my opinion, and even on the daily chart of QQQ. This is a little too large. If you look up bear flags relative to the flagpole, again, the whole nature of it, we did have the impulsive breakdown, so it had the potential to be that. At this point, it no longer is, at least not textbook. I told you yesterday we're up, but we would really need to start reversing soon to keep that, because I like the bear flags I like to trade they don't let you out, the longs out or the shorts in once they break down. It's a very impulsive drop, just like the flagpole leading up to it, right? So far now we're up from the lows that day. That was a red candle, but we're up quite a bit, and it could still play out, guys. I'm not saying that it can't to the measure target. It's just not textbook. So what I'm going to do, I'm going to take away that measure target line now, and we're going to talk a little bit on this divergence here. Okay, so as I mentioned the other day, we have positive divergence here. It's not the cleanest, but it is certainly by all definitions, positive divergence. The indicators, this one's the PPO, this one's the RSI, momentum indicators, have made higher lows over these previous lows, with prices making lower lows. And so that could be the catalyst for, again, a double-digit rally. If it's a double-digit rally, I would prefer to be long that double-digit. I don't think that's going to happen. Why? Well, first of all, we've already broken down. Back tests got rejected off the 200s. We're in close proximity. If we were further down, I might look at another run back to the 200s. But so for that and other reasons, again, I'm open to it. And that's why you hear my voice. I'll tell you when my convictions are high and I'm pressing longs hard or I'm pressing shorts hard. I'm doing neither now. I'm waiting for this market to kind of show its hand here. But let's do this first. Let's go back to, well, let's look at that. Okay, so look at where we are. Again, we're just coming off the first rejection. We could have a second rejection. We could have a pop above. And remember that my long-term outlook doesn't even begin to change until we're well back above 500 on QQQ. That's back into this trade, the topping range here. And like I said, I'd let them go a little bit into it up to about 510 before I become too concerned. So, that's plenty of upside if the market, I don't favor it. I would, in fact, where we're at, I think yesterday, and this is an extension of the April Fool's rally, and I just gave you the reversal point. So I think it's over for at least, from the minute I just said it a couple minutes ago, to quite possibly the end of it. And that's what I kind of am leaning towards. So I am short. I've stayed short through this thing today. Not fun, but I got to expect when you're trading a bear market, you're going to have 3, 4, 5% counter trend bounces that are just part. And if you want to grab, keep your eye on the prize, you're going to have to ride those out sometimes. when I can game them, I like to game them. And but when I see them, if I am short and I think there's going to be another leg down, I'll just add to my positions if I have that dry powder to add. If I don't have my fill of shorts, and that's what I just did. So, all right, yeah. So that's now. Let's go back to then, and then would be I'm going to do what I've been doing, compare it to the last bear market that we had. And so we can compare notes, what things look like back then. Okay, right here. So, okay, our first divergent low right there on the daily chart, where we had a nice rally. Remember, there was a little one there, but that proved to be just like now, actually. We started to get divergence right here. Just like now, we had a 3-day, well, it was a little more than 3 days. It looked like about a week. One big reversal off the lows. We were down big that day, and then a reversal. But prices didn't bottom for a tradable bounce until then, and it was a 17% bounce. That is, if you look at the crosshairs here, pop-up box to the left, that was March 14th. And you can see, again, I'm going to draw it for you. Had that kind of clean divergence I like to see with clean separation. Two distinct troughs in the PPO and in the RSI. My lines have been turned down. I have lines here, old lines. I just kind of muted down because that's past stuff, and so that's why they're not. It's bright, but you could see divergent low there. We also gamed that one, so let's talk about that. So again, that was what March 14th, 2022, and the rally again was 17%. So let me do this. Okay. March 14th, 2022, right here. QQQ, testing previous lows. NQQQ offers an objective, although fairly aggressive long entry for active traders that might want to game a quick bounce here, with a minimum target, again, of 326 on QQQ. You can see the error here. Let me expand this here. There's the chart. Looking for a bounce because we had that nice positive divergence. This happens to be NQ futures. And you can see the my minimum targets there. That was it. And then we had, let's go back to the chart. So we were long there. That rally, I'm going to zoom in even tighter so you can see this on the video. Remember, there were other reasons I do videos that cover a lot more than I cover in these quick screenshot posts. So you can check the videos back then. But that is March 29th was the high, the end of that 17% run. And you can see I had this nice clean trend line here, uptrend line. And that broke down on the following day, March 31st. I'm sorry, March 30th. Let's go to March 30th. Okay, this is March 30th. This is pre-market. You can see these charts were posted well, and it's overlapping this. When I expand it, it says under there 7:20 something a.m. You can see 7:55 a.m. in the morning. So I made sure to get it out. You know, when the markets are moving, I'm going to do this. I'm up early. I'm up late, looking at charts, and I will get things out to you early if it needs to be, if there's a reversal point. So we got in front of that breakdown with near impunity. Showed you these bearish rising wedges with QQQ sell signal to come on a solid break below this uptrend line / 60-minute rising wedge. Again, that was the morning of. So, and we got it, came right after that day, after the markets open. So you had plenty of time, if you were up at 8 in the morning. And that was it. And that was also the 200s being hit. So this is the initial targets. NQ sell signal to come. Same thing. I gave it to you in QQQ as well as NQ. And that was it. So that's how you nail the lows and then exit at the highs and get back in. And remember, I still had longer term targets. I told you the VIX. Let's see if you also offers an objective long. That was again on March 30th. Let's see what the VIX did on March 30th. Back then I was using VXX, so we'll look at VXX. March 30th. March 30th. Oh yeah, VIX didn't respond that much back then. Look at that, VXX. March 30th was right here. Actually, it's pretty good. It's 18% pop there. 18% pop on the initial drop. Surprised it didn't. Yeah, there's where it woke up. This one, I got away from using VXX. I forget one reason it was an ETN. I talked to you about that recently. At this point in time, I'm sticking with that proxy. I trade the futures, but again, it still played out for at least an 18% bounce there. And the market, as we know, again, go back to where we were, took its next leg down. So let's see, go back to that one more time, and then we will wrap this video up. I'm going to just make sure there's not anything else I need to update for you. So that was it. That was the how the charts look. And again, my takeaway was we had positive divergence, as I just showed you from those charts back then, clear positive divergence on the futures, on the stock index, ETFs, SPY, QQQ, everything. And that was the kind of bounce I like to gain for what I call double digit, bounce back to the 200. Oh, and look, we were also a lot further under. This is the 200 exponential, the red line here, in the 200 simple. This point here, we had already back tested them once or twice there, for about a couple days, a little pullback, and then had that thrust down. So this is kind of that where we're at on the map, where I think we're at, guys. Remember, we gained just like now. This is back then. Remember, I'm looking at 2 years ago when the last bear market hit and how we traded it. We were short right off the highs. I had the same trading ranges there. They were broken. Little attempt. See, there was a good attempt where they tried to run it back in, shake out the weak-ended shorts, suck in some more longs. Then the first drop came. We short the back test of the 200-day moving averages. Had divergence setting up then, but we had to go lower before it actually played out. We had to extend the divergences. So I kind of think we're in this kind of stage right here where the April Fool's rally right there. And again, this was back then. It was a different point in time. But so that's it. So if we do get that other thrust down, let's talk about that. Let's go back to what that other thrust down might do. Let's go to let's go to board 8 here. I have the longer term targets. Okay, so T2 was already hit before. T3 is down here. Let's toggle over to weekly chart. I think that's better to do. T8, okay. So if we go down here, remember, that's one more thing I wanted to do, guys. I'm sorry, I'm talking to myself here as I'm doing this. Back then, this was that first bounce, I said in March. Yep, first the one that I just showed you gaming that week of. And you can see, I think you can see, and if you can't, I'm going to let you see here. We're going to pull this up. We were also closer to being oversold at that point. It wasn't the end of the bear market, but we were much closer to that oversold level on the weekly. Like I said, and I didn't queue it up, but I'll bet you if I go back there, yeah, you know what? Why don't we just do it? Okay, and then I'll wrap the video up. Let me pull up my put to call ratio and take a look and show you what was going on back then versus now. Yeah, no, we were at the same level. Let me go to another board. Hold on. Yeah, this is it. Okay, I knew I had just looked at this the other day. All right, so this was the peak. I had the S&P 500 below just because I had it there. If I change this now, it kind of changes everything. I put the NASDAQ. As I've told you, the NASDAQ peaked a little bit before, technically back in November, put in effectively a double top high. This is the S&P, which peaked right at the start of 2022. So that was the beginning of the last bear market right there. As I highlighted recently, we hit for the first time since that last peak, right when the bear market started, my CPCE weekly. That's the one I was wanting to get to. Put to call ratio, equity only. Been covering this quite a bit lately. Showed you here that was when the last bear market started, when we hit that level. And I also said it's not an exact timing indicator, but that's what you want to look for. That means everybody got to my red level where everybody's super bullish, and that's where corrections or bear markets usually begin shortly thereafter. And so far, again, we turned. Market peaked. NASDAQ, again, peaked first back then anyways. But let me show you this. So this was that first counter trend bounce right here. It looks tiny in this little chart because it's so big. That was at 17% bounce. The bottom was right there. And where I'm showing you when I come up, we just got this bearish right before that. This is the put to call ratio, meaning the higher this goes. This is my green zone. This is extreme fear. Everyone's buying puts. Nobody wants calls because they think the world's coming to an end. That's when you want to start getting bullish, when everyone else is bearish. But they were getting pretty darn bearish. We were, way off the lot. So that initial spike had a lot of bearishness. This right now, if we're in that same part of the roadmap, people might be coming out saying they're bearish on TV or whatever, but they're not showing it, not on the put to call ratio. And this is what I call my money. Put your money where your mouth indicator is, because this shows true put and call buying on stocks, not the indexes, which are typically used by commercials to hedge. Commercials will use and that's why I favor the CPCE versus the CPC or the CPCI, which is CPCI is an index only put to call ratio. CPC is the total put to call ratio, as indexes and stocks in there. And so this is the most effective one. So yeah, when I start to see some fear come into the market, then I'll be more of a believer in these, the bear market rallies. As of now, I am looking at them as opportunities to increase short exposure, as I just did. So if I stop it here now, I can get the video out to you. And again, by the time it processes, you're going to get it. And if I'm right, there's going to be a little turn in the market today. But you got to, lay out these videos, mark the levels, replicate your charts, have your own trading plan. It may be different from mine. And if going back to that, if you are bullish, looking for a lot more than the same level I just told you that I just shorted, you want to see breakout to add along. The last thing you do, you don't go long on a rally into resistance. You want to wait for either breakout above resistance or a pullback to support. So that's how those of you that are taking the other side of the trade as me can use my same analysis. Whereas right now, I think it's lights out under about this recent low, about 19,300 right here, where I just drew that line. To me, that's it. Everyone else will say, oh, the recent lows. I think this will do the trick. We take out 19,300. And so therefore, you might use that, if you're bullish, as a stop loss right there. Again, if you agree with my analysis. Or, of course, a stop under the recent lows. All right, let me wrap it up, get the video out to you guys. This has been Randy Finney with Right Side of the Chart.